Today we're discussing full versus fractional reserve banking. This is a very important topic for anyone who's looking to invest global or understand more of the macroeconomic landscape we're currently in 2021. So just to understand from a very kind of nuanced framework is full versus fractional. So fractional reserve banking is typically a free account, and we'll get into all of this in detail with examples and things, but it's basically a free account. The reason it's free is because the bank is making profits off their capitalized interest off what they lend out. So typically in the US, they actually only hold about 10% or less of your cash reserves on hand. This is a big issue as we've seen throughout history runs on the bank and kind of with the weakening of the US dollar, more money printing. We could see something like this happen in the future, not too far ahead, but that's basically the idea with fractional reserve banking is, again, we'll get into detail on this, but fractional reserve banking is they're basically creating money off of your deposit. So let's say you deposit $10,000, 10% of that, usually it's a lot less, sometimes it's even 1% is actually cash deposit. Usually, they save that $100 for you. They lend out that other $9,000. They're earning interest on this, and then they're making a profit because what they pay you in interest is so tiny. I mean, it's really pathetic when you look at the percentage there versus the percentage in something like the blockchain space, where if you're using BlockFi, you can get 8.6% APY. You're using Celsius Network, you're getting around 25% APY, and that's not even to mention the staking platform. So that's kind of besides the point, but it's really pathetic, the percentage gains you're getting there. Look to a place like Mongolia, a country like Mongolia, much better interest rates. Look to a place like Georgia, I mean, incredible interest rates. If you're looking at the euro dollar system, the euro dollars, which is not just dollars in Europe, by the way, we'll probably make a video on this, but the actual dollars outside of the US domestically. So you have the domestic dollars versus the international dollars. The international dollars have much higher interest rates, but they're much more volatile at the same time. So domestic US dollars, that's kind of where you're seeing fractional reserve banking. And the reason, by the way, that the euro dollars, which it's a confusing name because it's not just European US dollars. It's euro dollars is the name for dollars completely outside of the US. So it can be in Asia, it can be in the Middle East, blah, blah, wherever. It can be in Antarctica. That's a euro dollar. It's just the name they decided on. But maybe we'll make another video on that. The point is the domestic US dollars. When you're looking at fractional versus full reserve banking, fractional is basically them lending that out. It's a free account, and it's not really your choice who they lend them out to. But with full reserve banking, you usually have to pay for an account. Pretty much, I would say 99% of the time with full reserve banking, you would have to pay for an account. Then they hold all of that on hand. It's basically a fee they charge for holding all of the cash. Because if the fractional reserve bank was actually holding all your cash on hand, it wouldn't be free, okay? That's kind of the paradox. A lot of people say like nothing in life is free, and maybe it's true. I would argue maybe free samples, but who knows? Anyways, so with full reserve banking, you have this situation where they hold it on hand for you, you're paying the fee, and then you have the option, if you want to earn an interest from one person. So they're not creating more dollars out of this, whereas with fractional reserve banking, they are. And this, we'll get into the complications of that, where they're actually creating more dollars out of your deposit that are kind of like out of thin air. And that's how we've seen a lot of banking collapse. That's how we've seen a lot of run on the banks. But with full reserve banking, they're just lending it out to one person. So let's say you deposit $10,000. You want to keep 10% of that on hand. You go, okay, maybe I'll do the same situation as the fractional reserve banking, but I'm just lending this. They're just lending it out to one person. So they're only lending out, $9,000 to one person. Once that person pays back with interest, you get a percentage. The banker gets much less of a percentage, and it's much more like I guess open source, or much more transparent is a good word for it. Whereas with the fractional reserve banking system, which we'll kind of get into, so let's go back to the example. You deposit $10,000, okay? They keep $100 or $1,000 rather. They keep 100 of it on hand, 900 of it. I'm just using $1,000 for easy math. 100 of it on hand, so about 10%. That's a round number. 900 of it, they go, okay. We're going to lend this out, but we're not going to necessarily tell you. You go in there, you ask them, I'm depositing $1,000. Can I get this at any time? They say, yes, here's your little mobile banking app. You can see $1,000. But if you watch them in the bank, they're putting $100 in the cashier's area. The $900, $100 in the cashier's area. The $900, they're not putting with that $100. they're keeping out and they will loan it. So this is kind of interesting because you ask them, go open a bank account and ask them if this is true. Can I pull out at any time? They say yes. Whatever is shown on your balance, you can pull out at any time. But they don't necessarily have that there. They're telling that to all the customers. So let's say they go out and lend that $900 to Bobby. Bobby wants to, Bobby wants to buy a brand new TV, like a flat screen TV, very, very nice. He goes over to the TV store or Best Buy, wherever, buys the TV with the $900. He's all happy. He has to pay interest back to the bank. But now the TV store owner has that $900. So he takes that to the bank. Boom. Same thing. I want a bank account. Oh, perfect. It's free, fractional reserve banking. Okay. So can I pull it out at any time? Oh, yeah, for sure. Then the banker, 10% of it, so $90, boom, in the cashier's area. $810. Now, that doesn't go in the same area now, does it? So, bye-bye to Bobby. Now, Janice comes along. Janice says she wants a loan. She wants $810. She'll pay interest on it. She's, great credit score, blah, 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 blah. She wants to buy, she wants a little bit more money for inventory for her business, let's say. So she takes $810. She has to pay interest on it. Bobby and the original guy are only getting a fraction, remember, of the interest paid on these things. They're getting typically less than 1%. It's really sad. But Janice goes out, she funds her business with new inventory. Let's say she owns a convenience store. She pays the wholesaler, boom, $810, wholesaler, same thing. Goes to the bank, fractional reserve, and it keeps repeating. And you see how this is creating money out of nowhere, because the issue is here is you're borrowing from Peter to pay Paul. That's kind of the idea. So with the fractional reserve system, it does create economic growth in a way. If you're kind of the Keynesian economic style, which we'll record a video on Keynesian economics as well, but if you're more of the, more monetary stimulus, more money flowing in the system is a good thing, which it is in a way, but this is kind of nuanced. Again, this is a bit nuanced. If you think that more money being flowed in the system is good for economic growth, well, then this seems fine. Fractional reserve banking seems fine. But when you keep borrowing from Peter to pay Paul, when you keep having this kind of there's a great saying that goes, a nation is born stoic and it dies Epicurean. So the Stoics are the people that forego present pleasure for future gain. So kind of more long-term thinkers, but the Epicureans are more of like the YOLO mentality. They just give in to short-term pleasures all the time. And this isn't the best thing to do, because when you're in this situation where you keep lending out and borrowing from Peter to pay Paul, at a certain time, Peter's going to get pissed off because that original guy who had $1,000 in his bank, now that the banks lend out to maybe you have 3 people down the line and it's down to $500. We went from $900 to $810, then you would have $81 out, and you would have what? So you would have $700, whatever, to the next person, and it keeps going down. Let's just say using that 10% number, certainly you get it down to a tiny amount, and then it's okay, you've created all this wealth or this money supply kind of out of nowhere, out of this one guy's deposit. And it gets this kind of insane situation where it's okay, if that's the case, that you're just a Keynesian and you believe that, you should always have money flow, well, you have to think about the broken window fallacy, which we'll end it out with this. I know, so that's basically full versus fractional reserve banking. I hope you understand that. Full, it's a paid account. They typically keep your deposits on hand. You have the option to lend out. Fractional, it's a free account, but they lend out and they kind of create this money in this Keynesian style way. But the fallacy with this kind of style of thinking is this broken window fallacy, okay? So why would someone think that breaking a window is a good idea for economic growth? Well, with this mentality, they go, okay, I broke your window. Let's say somebody comes in here and breaks this window. They go, no, this isn't a bad thing. This is a good thing. I'm supporting the economy. You're going to have to hire a handyman to come in and fix the window. Also, he's going to have to buy glass, which you'll pay for. So it's creating economic growth. The guy who's the handyman is going to go buy some food. He's going to buy lunch and then maybe buy his girlfriend dinner that night. Okay, so that's creating economic growth, but that's out of this money that was made from the broken glass window. Well, then why don't we just break all the windows? This is the fallacy. If we really just needed to break all the windows, that would be the kind of full, arguing ad absurdum. Okay, that's kind of a logical tool. And the broken window fallacy helps us kind of understand this a bit better, that this is a very complicated situation. You can't just have a black and white way of thinking with Keynesian economics and go, okay, just more things, spending money more and more, spinning the wheels faster. No. We have to slow down and really, really look at quality economic growth. It can't just be people breaking windows all the time. You can't just go around to all these businesses, break windows, and then go, man, this economy is going to be stimulated. It's a horrible way of thinking. And it's the same with our current economic system where we're just going, okay, we're just going to print $1.9 trillion. And really, they're not even printing it. It's just a digital ledger. They're just adding more. They're adding another zero, which is even worse. But that's for another topic. Anyways, this was full versus fractional reserve banking. Let me know your thoughts in the comments down below. What you think, which is better, fractional or full reserve banking? Are you more of a Keynesian economic person or more of an Austrian economic person? I'll be making videos on all these things. Eurodollar system, if you don't understand that. Keynesian economics, Austrian economics, MMT, all of these things coming down the road. So thank you very much for watching. If you enjoyed this video, like, subscribe button all, hit the like button. Definitely subscribe to our channel so you keep up to date. And then the notification bell and all is important because we post time-sensitive content. Thank you very much. As always, invest global. And until next time.